Iron Financial. We're the place you come to forge a stronger portfolio because we stress test the market's biggest bets. And today, we are putting Meta Platforms under the heaviest pressure we can. Why? Because their latest earnings report, it reveals a plan so massive, so audacious, it's either going to redefine the entire company or it's going to shatter its very foundation. So this isn't just another earnings breakdown. No, this is an analysis of a Titan's monumental gamble on the future of technology itself. Let's get into it. Just look at this number, $135 billion. Let that sink in for a second. That is the high end of Meta's projected capital spending for the year 2026. A single year. I mean, to put that into perspective for you, that's more than the entire annual economic output of countries like Hungary or Kuwait. This isn't just an investment. This is a declaration of war for the future of artificial intelligence. Meta is signaling to the world that they plan to outspend, outbuild, and outmaneuver every other player on the face of the planet. The sheer scale of this it's almost hard to comprehend.
Whoa, hold on a minute. A declaration of war? That's some pretty heavy language. Before we all get swept up in the epic scale of it all, we have to pump the brakes and ask the one question every single investor should be asking themselves right now. Is this a stroke of absolute strategic genius? A visionary move to lock down the next decade of tech dominance? Or is this a breathtakingly arrogant, fiscally insane gamble that could seriously cripple one of the most profitable companies the world has ever seen? I mean, that's the real question on the table, isn't it? And that is exactly the question we're here to answer. We're going to break this down, piece by piece, using the hard numbers. No fluff. First, we'll analyze the engine that's actually funding this entire operation, Meta's $200 billion a year machine. Then, we're going to dissect this superintelligence gamble itself. What is it really? From there, we'll look at the colossal cost of forging this new industrial titan. After that, we do what we do best here at Iron Financial. We'll search for cracks. We're going to stress test that balance sheet. And finally, we deliver our verdict. Is this a fortress in the making, or is it a monumental folly? Okay, first things first. Before you can understand the bet, you have to understand the bankroll. And let me tell you, Meta's bankroll is a fortress. Before a single dollar is spent on this AI moonshot, we need to establish the raw strength of the underlying foundation. The family of apps, that's Facebook, Instagram, WhatsApp, it's not just a cash cow. It is a meticulously engineered financial engine that generates absolutely staggering amounts of capital. The question isn't whether they can afford this gamble, it's whether they should. But first, let's just establish the raw, brute power of this engine. All right, let's get right to the numbers. The sheer scale here is it's wild. Full year revenue for 2025, it blew right past the $200 billion mark for the first time ever. That's a 22% year-over-year increase. Now remember, this isn't some sleepy, mature, slow-growth company. This is a titan that's still accelerating. Now look at income from operations, $83 billion. That's pure profit from their core business, and it's up 20%. But, the skeptic in me immediately hones in on that operating margin. It dipped just a little, from 42% down to 41%. It's a tiny drop, just 1%, but it's not nothing. We're going to circle back to that. For now, though, the crucial point is that the financial bedrock of this company is a mountain of solid granite. And that mountain is still getting bigger. This isn't just some financial wizardry on a spreadsheet. The actual operational metrics are firing on all cylinders. Get this, daily active people across their family of apps hit 3.58 billion. That's a 7% increase. At this scale, they are still adding hundreds of millions of daily users. And here's the kicker, they're monetizing them more effectively. They delivered 12% more ad impressions, and, this is crucial, the average price per ad went up by 9%. That shows incredible pricing power in the market. But the number that really, truly matters for our analysis today is right there at the bottom, $43.5 billion in free cash flow for the year. That, right there, is the war chest. A war chest they seem absolutely hell-bent on emptying. Okay, so we've established it. The foundation is solid rock, the fortress is strong, the engine is literally printing money. And what do they decide to do with it? They take the keys to this perfectly running money-printing machine and they hand them over to a brand new project. A project that is, let's be honest, incredibly ambitious, very vaguely defined, and, as we've seen, astronomically expensive. This is the pivot point, right here. This is where the story shifts from a strong, stable, predictable business to a high-stakes, all-or-nothing gamble. And this right here is the blueprint for that gamble, and it's coming straight from the top. This is Mark Zuckerberg's quote from the earnings release. This isn't some little side project or an experiment. This is the stated #1 priority for the founder and CEO.
He is personally staking his reputation and the company's entire future on delivering something he calls personal superintelligence. This one phrase is the strategic justification for that $135 billion spending spree. Everything, and I mean everything, now hinges on what this actually means and if it can ever generate a return. Exactly. What on earth is personal superintelligence? I mean, seriously, this sounds like something ripped from the pages of a science fiction movie, not something you find in a corporate earnings report. Is it just a better chatbot, a smarter news feed? Before we can even begin to analyze the financial viability of this thing, we need to cut through all the jargon. Is this a real product? Is it a tangible service that people will actually pay for? Or is it just a fancy, multi-billion-dollar R&D project with no clear path to actually making any money? This is exactly the kind of vague corporate speak that should make any serious investor extremely nervous.
Okay, let's try to put a definition on it based on their own documentation. The stated goal is to build an AI that understands you on a deep personal level, your habits, your needs, your goals, all to provide more intuitive and helpful interactions. So think of an AI assistant that doesn't just answer your questions, but it anticipates what you need, it manages your schedule, it summarizes your communications, it acts as a true digital partner. That's the technical vision. But you are absolutely right to be skeptical. More intuitive interactions doesn't exactly sound like a line item on an income statement. How do you monetize that? Does it make the ads 10% more effective? Does it become a subscription service that people have to pay for? The path from this concept to actual revenue is completely undefined right now. They are betting that if they build the most advanced AI on the planet, the money will just follow. And that, my friends, is a massive leap of faith. And it's a leap of faith that requires a complete and total transformation of the company's DNA. See, building this superintelligence isn't just about hiring a few thousand more coders in Silicon Valley. It requires a monumental shift in how they allocate capital. Meta is moving from being a software company, one that deals in bits and bytes, to becoming an industrial-scale powerhouse that deals in concrete, in fiber optics, and in raw energy. They're literally forging a new kind of company from the ground up, and the cost of that forge is unlike anything we have ever seen in the world of tech. And this chart right here just brilliantly illustrates the sheer violence of that shift. On the left, you see the capital expenditure for 2025, a massive $72 billion. That's already a huge number, bigger than most companies. But then look at the projection for 2026. At the high end, it jumps to $135 billion. They are nearly doubling their capital spending in a single year. This isn't a gradual increase. This is a vertical step up. It's an all-in move. To see a company of this size decide to effectively double down overnight is, well, it's wild. The board of directors must have had an iron stomach to approve this. This chart represents an enormous amount of risk being taken on in a very, very short period of time. And here's where all that money is going. This isn't just for a few extra servers. I mean, look at the shopping list. This looks like the shopping list of a nation-state, not a software company. A $6 billion multi-year deal with Corning just for fiber optic cables. They're building their own physical network backbone. Then there's energy, agreements for up to 6.6 gigawatts of nuclear power. They're not just buying power off the grid, they are literally underwriting the construction of new energy projects just to power their data centers. And finally, talent. They are paying whatever it takes, no price is too high, to assemble a team with the highest talent density in the industry. Each one of these is a massive, long-term, and frankly, largely irreversible financial commitment. So the crucial point to take away from this is this. It's a fundamental rewiring of the entire business. Success in AI, according to Meta's playbook, is no longer just about writing the best code. It's about managing physical supply chains. It's about securing massive energy grids. What they are really building here is a massive, capital-intensive barrier to entry. This is a classic industrial age strategy. Think back to Standard Oil building its own pipelines, or AT&T laying all the phone lines across the country. They want to make the cost of competing in high-level AI so prohibitively expensive that only a handful of players can even afford a seat at the table. A moat built with $100 billion of debt and equity? It better be insurmountable. But here's the thing. No structure, no matter how ambitious, no matter how well-funded, is perfect. So it's time to do what we do here. It's time to apply some pressure. We've seen the strength of the foundation, and we've seen the incredible, crushing weight of the new structure they're trying to build on top of it. Now, let's search for the cracks. Let's see if this foundation shows any signs of weakness under this new immense load. And boom, here's the first one. Now, it's subtle, I'll give you that, but this is the first hairline fracture. A minute ago, we were celebrating that 22% revenue growth. It's a fantastic number, no doubt. But look at the other side of the ledger. Total costs and expenses for the full year grew by 24%. Their costs grew even faster than their massive revenue. This, my friends, is the literal definition of margin compression. It means that for every new dollar of revenue they brought in, it cost them more than $1 in new expenses to get it. This is a clear signal that the heavy lifting of this AI pivot is already starting to weigh on profitability. This is a trend you have to watch like a hawk. And here's crack number 2. This is the total long-term debt sitting on their balance sheet as of the end of 2025, nearly $60 billion. Look, this isn't monopoly money. This is a substantial liability that has to be serviced, meaning they have to pay interest on it. And while the company is wildly profitable right now, adding this level of debt reduces your flexibility. It creates a fixed cost that has to be paid, rain or shine. When you're embarking on the most ambitious and uncertain R&D project in your company's history, having a nearly $60 billion anchor of debt tied around your neck is a significant potential weakness.
Okay, that's a fair point. But you have to look at the whole picture. Let's not be alarmist here. While the debt is absolutely substantial, it is more than offset by this number, $81.5 billion in cash marketable securities. They could, in theory, pay off their entire long-term debt tomorrow and still have over $20 billion left in the bank. This massive cash reserve is the ultimate shock absorber. It provides a robust buffer against any short-term downturns and gives them immense operational flexibility. So yes, the debt is a concern, but the cash pile is a formidable defense.
And this right here, this visual, it just brilliantly illustrates the central tension of this entire story. On one hand, you have this incredibly powerful, established brand and business, the engine that prints money day in and day out. On the other, you have this monumental, uncertain, and frankly, capital-destroying ambition. The entire investment thesis for Meta now boils down to one single question. Can that legacy business, as strong as it is, generate enough cash for long enough to support the construction of this new AI empire before the crushing costs crack the very foundation? The two are now inextricably linked. One cannot survive without the other.
Which brings us to our final analysis. We've laid out the foundation, we've examined the blueprint for the new structure they're building, and we've stress-tested the weak points. So now it's time. It's time to weigh all the evidence and deliver the iron financial verdict. Is Meta building an impenetrable fortress for the next generation of technology, or is this a tragic folly of truly epic proportions? Okay, let's break down the two opposing theses here. The bull case is crystal clear. This is a calculated, aggressive move from a position of immense strength. A cash-rich titan is front-loading a decade's worth of investment into a 2-year window to build an unassailable lead in the single most important technology of our lifetime. They're using their current dominance to finance the creation of an industrial moat so deep and so wide that no one will ever be able to cross it. It's a bet on total, long-term domination. But the bear case is just as compelling, just as believable. This is a company sacrificing its stellar profitability for a vague, undefined science project. They are chasing a concept, superintelligence, without a clear path to revenue, and in the process, they are letting costs spiral completely out of control. It's a massive execution risk, and the margin for error is shrinking with every single $1 billion they spend. So that's the final question we leave you with today. This is the dilemma every single investor in Meta and, frankly, in all of big tech now has to face. We are witnessing one of the largest industrial projects in modern history, funded by one of the most profitable enterprises ever created. Will this forge, burning through over $100 billion a year, create a stronger, more dominant fortress than we've ever seen? Or will the sheer weight of the ambition, the debt, and the raw expense prove to be too much for even Meta's foundation to bear, causing the whole structure to crack? That's the billion-dollar question you now have to answer for your own portfolio. Thanks for joining us at Iron Financial.